the best of Money Matters.
Market View on Money FM 89.3.
That's right, you're tuning in to Money FM 89.3. Time now for Market View with me, Chua Tian Tian, where we take you through how the Singapore stock market closed for the day, the biggest movers, sectors, and of course the companies to watch. But as always, a quick recap of some key movements. Well, Singapore shares dipped today despite a broadly positive day in Asia. So if we look at the Straits Times Index, it was down 0.2% at 4,347 points at about 2:25 p.m. Singapore time, and that's with a value turnover of some 836 million Sing dollars seen in the broader market. Now let's take you through how the Singapore stock market ended the day. The STI ended further in the red, down 0.27% at 4,344 points. Now, in terms of value turnover, that's 1.38 billion Sing dollars. Gainers outnumbered losers, though, 367 versus 190. Top advances for today, we've got for you GMXUSD, Jardine Cycle and Carriage, and Great Eastern. And top decliners, we've got here DBS, UOB, and Centurion. Now, in terms of counters to watch, we do have CapitaLand Investment and CapitaLand China Trust, because CapitaLand Investment said today that CapitaLand Commercial C-REIT's public offer was, get this, 535.2 times subscribed. Meanwhile, from what an inline inflation print out of the US means for investors to how the SGX will launch an index that tracks listed companies that are not constituents of the STI. We've got more economic and also local headlines in focus. And joining me on the line today is Benjamin Goh, Head of Research and Investor Education at SIAS. Ben, welcome back.
Hi, Didian. How's it going?
Good. And let's start with global markets, though a lot of local headlines to go through as well. But in the US core CPI increased 0.3% in August from July as expected. The market sentiment right now is for the Fed to cut rates. But what are you expecting in terms of the magnitude for cuts, and how far will rate cut bets help markets in the US and in Asia extend record highs?
Well, the market has largely priced in a 25 basis point cut. This is based on the option prices that we see in the Chicago Board of Exchange. So if that actually happens, there shouldn't be any kind of significant move in either direction. Then the other shoe that drops is, of course, you have got last week's employment numbers as well as yesterday's initial jobless claims number. That was a huge wake-up call that the U.S. labor market is far weaker than the market has assumed. And the kind of the fear factor over there is extended so much to the fact that the market is already pricing in an additional 25 basis point cut in October. That's scarcely 1 month away. So if you look at what's been happening in the U.S. equity market, trading momentum is mainly driven by AI investments. And I don't think the deteriorating economic fundamentals in the U.S. is likely to derail that. Because after all, if you look at the time frame, recessions tend to last about a year or so, while building out an AI data center takes far longer than that. So markets, I think, may continue the way it has always been, or it may be entering a slight correction period, when investors do get cold feet, but it's unlikely to last too long.
And if we go back to the Singapore stock market as usual, Ben, how did the STI fare today? Any surprises when it comes down to the biggest movers, say Yangtze Financial, which hit an all-time high?
A bit of sector rotation today. The large caps components were down, largely driven by the three local banks, with DBS leading the decline at 1.45%. So not really based on any kind of fundamental news. So it does appear that investors are taking some risk off the table, given the clear signs of weakness in U.S. economic fundamentals. As you pointed out, yes, that's a big surprise. Yangtze Financial closed up at 7.4%. Didn't see any change to the fundamentals today, so probably because upswing is probably because of technical trading reasons. So I looked at the chart. It does look like the stock is currently trading at the upper bounds of its price channel, but the upward momentum, the upward trend of the price channel itself is still intact. So this is probably not going to be the last time we're going to hear of higher highs from Yangtze Financial.
And let's talk about the two CapitaLand counters we mentioned earlier, CapitaLand Investment and CapitaLand China Trust. movements today because CapitaLand Commercial C-REIT's public offer was 535.2 times subscribed. What do you make of the reception for CapitaLand Commercial C-REIT's Shanghai IPO? And what does the reception mean for investors of CapitaLand Investment then?
Well, the knee-jerk reaction is, obviously the IPO is a stellar success. Fantastic news for the sponsors, CapitaLand Investment as well as CapitaLand China Trust. Given the mind-boggling numbers, we would expect that the first day of trading, which is going to be end of September, on the Shanghai Stock Exchange is going to be pretty interesting. So you might have a nice pop. But the challenge is that from some perspectives, the Chinese stock market may be a little bit overvalued right now, a little bit of, valuation is a bit rich. So, investors could be chasing the next big thing. The stock price may get a nice pop, but it definitely needs to deliver on good fundamentals to continue the momentum. Coming back to China CapitaLand Investment, the company only has got it holds a minority of the IPO units. So upside to the company itself, CapitaLand Investment, may not be as large as investors hope.
And in the meantime, Hong Leong Group's executive chairman Kwek Ling Beng said at his first meeting with Shanghai Party Secretary Chen Jingning that Hong Leong Group has abundant opportunities to deepen its presence in China and in Shanghai. Any thoughts on that? And what implications will this have on then Hong Leong Asia, which is listed on the SGX?
Well, definitely a big plus. But if you zoom back, Hong Leong Group as well as City Development has had a presence in China for a long time. Like 20 years or so. So I don't think this meeting will fundamentally change the competitive landscape for Hong Leong Group. And after all, this is not Singapore, this is China. So there are a lot of homegrown big players in the Chinese market itself. But it's certainly a positive sign that the local Chinese government or local Shanghai government is reiterating that it welcomes foreign investments. And obviously, this is a sharp contrast to the mixed messaging from the U.S. So I think this is a positive note. But I don't think it's going to move the needle.
If you're just tuning in, we're now in conversation with Benjamin Goh, Head of Research and Investor Education at SIAS. Ben, I do want to stay in Singapore because the Singapore Exchange will be launching an index that tracks listed companies that are not constituents of the Straits Times Index. Now, this, of course, is part of Singapore's efforts to showcase the broader equity market. What do you make of the move, and really what are the implications for both STI constituents and non-STI constituents?
Well, there are about 600 companies listed on SGX. The interest for the majority of institutional as well as retail investors, tend to focus on the STI constituent stocks. That means the top 30 by market cap. There are many hidden gems outside of the STI index. So, creating a new index that broadens the scope, or rather the coverage beyond the top 30 companies is certainly a big step forward. And it's not just the index, because once the index is created, then you have got market intermediaries, banks, as well as issuers. Then they can create new products, things such as exchange-traded funds, as well as unit trust funds, can be all built around the new index. This certainly is a definite improvement, because it will add more depth as well as accessibility to the Singapore equity market. And certainly there will be more investor interest, for those what we call the second-tier companies, as well as companies which are good potential and which require more, emphasis and focus to tap funding. So definitely a big plus for the development of the Singapore equity market as a whole.
And across the region, Ben, SK Hynix's stocks climbed as much as 5.9% today, also to a record, after SK Hynix announced that it had completed development of HBM4, the next generation of high-bandwidth memory crucial for AI work. How far are you expecting a rally in related AI plays, say NVIDIA, when U.S. markets open? And what does this mean for competitors of SK Hynix, though?
Well, the main competitor to SK Hynix is actually Samsung. So you think that Samsung, is a 800-ton gorilla, right? So, but it has always been facing quite a few challenges in manufacturing the type of memory that passes NVIDIA's certification process. So it's very, very strict. in terms of specifications and quality. So SK Hynix is already supplying NVIDIA, so this HBM4 basically further cements the company's leading position as NVIDIA's top memory supplier. So NVIDIA has cleared specific technical analysis thresholds this year in terms of charting, and therefore its stock price has got an upward bias. If you zoom out, the AI trend is still very much in play, but the market is broadening out. So yes, NVIDIA is still a sector favorite for the whole AI fad, but you also have got companies like Broadcom, which scored a major $10 billion contract with an unknown company, which is, I guess, suspected to be OpenAI. And then, of course, you've got Oracle, which guided to a 30% uplift in, profit for the next few years. So that's certainly, those companies are certainly very interesting. And of course, they provide platforms, services, and products which are adjacent to NVIDIA's core software, hardware ecosystem. So I think it's slightly different thing we're talking about. Not sure how that is going to play into NVIDIA's stock price today, given the, the fundamental economic data that came out of the U.S. But I think what is for sure is that the AI trend is very much dependent on continued capital expenditure. So long as Meta, Microsoft, OpenAI, if they keep building up their data centers, things will be great. But of course, they can't keep spending billions forever. So at some point, the capex will plateau out. But that's still going to be a couple of years out.
Okay, and finally, Ben, Meituan has launched a new AI agent app that aims to boost its food delivery and local services business. Now, this as its battle with Alibaba Group Holding for Chinese consumers heats up. What do you make of the move? And really, do you think players can compete without falling into that involution trap in China?
Well, the Chinese domestic market is huge, still very much up for grabs. Hence, the competition is still super brutal and cutthroat. So I don't think involution is going to go away anytime soon. If you think of it from a fundamental level, market competition is actually great. So consumers benefit from lower prices, you get better products as competitors try to outdo each other. Meituan's new AI app from the news feed, it looks like a combination of voice recognition as well as recommended AI systems. Not exactly bleeding-edge technology that's been around for a couple of years, but of course, the value add from Meituan is that they are packaging it into a handy mobile app and making it super convenient for consumers. So it really supports Meituan's ecosystem, makes it a little bit stickier for consumers to switch out to offerings from Alibaba or other rivals. So that's a plus, but I'm not sure whether that is going to move the needle for Meituan. So, but of course, if the app turns out to be a huge hit, then that's something else.
I see lots to watch, and thanks so much for joining us today, Ben. That was Benjamin Goh, Head of Research and Investor Education at SIAS. Thank you so much for joining us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.